Michael, thank you so much. Once again with Jeffrey Gundlach on a Fed decision day. It's good to see you. Thank you so much for being with us again.
Nice to be with you live.
Like to get your first reaction as always, because it certainly seems what was at the beginning was not what it was at the end.
Sure did. It kind of turned into a Lucy and Charlie Brown in the football sort of a deal. He throws out there that he's getting mindful of the tightening that's already gone past and respectful of the fact that there's lags in monetary policy, and that sort of created a little bit of a party. You had a big rally in the 2-year Treasury yield went down and stocks went up a lot. And then the presser comes, and it's kind of like old times when the presser comes out and all of a sudden the message starts to get sculpted a little bit differently. So he sort of contradicted himself. You know, he sounded kind of dovish with sort of a, you know, we've tightened a lot already. And then suddenly it's what we think rates are going to go higher than we thought before. And kind of put the kibosh on the idea of anything resembling a pivot, a plateau of quite some time. And I think that really was intentional to kind of, Powell said he had to thread the needle. He kind of like straddled the problem rather than threaded the needle.
We were watching it at the same time. You did think that it was significant that that language was put into the statement, the language of we'll consider the cumulative effects and the lag effects of what we've done to this point, and that was the dovish message. You thought it was important that it was in the statement.
Yeah, I mean, it's quite a shift from we need clear and convincing evidence, which were statements prior this year, and he put this one in, I think, to just show that he's mindful of the fact they've gone a long way. You know, Scott, I was very critical of the Fed back in May. I thought they were way behind the curve. I've kind of somewhat facetiously said they should raise rates 200 basis points and then see what happens. But they've kind of done that. And they were miles behind the message of the bond market. And now they're pretty much getting to be on the same block as the message from the bond market. And so I think that he's trying to make sure that he's not just perceived to be on a scorched earth path.
The real question is, what do they do from here? What should they do from here?
I think they're going to do what they should, because when I glue these statements together and try to figure out how they can be consistent with each other, I think what Powell said without saying it out loud is we're not going to raise 75 at the next meeting as a base case. I think that's kind of what he meant by we're respecting how far we've gotten. We know that there's lags. So I think we're probably going to get them slowing down. And the bond market has basically got the 2-year Treasury at 450, and that's kind of, you know, they're talking about 425, 450, so they're pretty in sync.
Larry Summers tweeted yesterday to the suggestions that the Fed should either slow down or pause very soon. He said it's, quote, badly misguided. On balance, given its past errors, the Fed should stay on the current course and then evaluate things. You agree or disagree with Mr. Summers, the former Treasury Secretary of the United States, who's been one of the chief critics of the Fed?
I was very much in line with Mr. Summers' thinking back in May to July. But I think what he's missing with this analysis, because he doesn't talk about quantitative tightening, because quantitative tightening has an effect, too, on things. Remember 2018 in December when we were on autopilot with both rate hikes and quantitative tightening, and they had to pivot almost immediately. So I think he's kind of missing that. Also, the big inflation pop that caused all this tremendous change in attitude at the Fed towards rate hikes was fueled primarily by the terrible CPI data of the first few months of this year. And so suddenly we went from very modest rate hike expectations to very big rate hike expectations. But of course what that means is those numbers are going to be rolling off. So while the CPI has been hanging out on the headline in the 8s and even got to 9.1, it's coming down next year. We'll end this year at around 7. We'll probably be at below 4.5 as a base case. Things can always change with commodities by the May reading. So I don't know. It just seems like if that's what's coming, you're getting the CPI rate down by a few hundred basis points, and we've got quantitative tightening, and the Fed did not say they're not raising rates. They quite frankly, they said they're going to raise them more than they thought maybe a few months ago.
But you think a slowdown is warranted for the very reasons you're suggesting, that you think inflation is going to roll over hard, like David Rosenberg has talked about in the last 24 hours or so, because of, in some part, the money supply coming down, that inflation is going to get crushed.
The money supply coming down is already a fact. It's not a prediction. It's something that's already percolating through. And the Fed raising these rates has inverted the curve. And the Fed got pretty frightened, I think, of how flat the 3-month to 18-month, which Jay Powell claims is his favorite yield curve analysis, how flat that got. So that all suggests to me that we're getting more, deeper into the process. And I think that Rosie is right, that when inflation starts to come down with all of this Fed activity, thanks to the M2 and the recent decline, which could be reversed, but so far recent decline in commodity prices, who thinks the inflation rate, well, the economists think the inflation rate is going to go from 8.2 today on the CPI to something like high twos, mid twos by the end of 2023. Some people even say 2% by 2023. And then the weird part of the forecast is they say it's going to stay there, right at 2 like a rock for the next many quarters, which is completely implausible in my view. If you're manipulating through policies a 7-point decline from peak to trough in the headline CPI in that compressed of a time frame, I think your chance of it stopping at 2 is very low.
You think it's going to go well below 2?
If they get, it's a conditional prediction. If they get it from 9 in the past couple of months down to 2, by the end of 2023, it's going to go negative, I think.
What about the terminal rate? Where do you see them taking that? There are suggestions by some former Fed officials. Fred Mishkin was on in the lead up to the event itself today, said 5 minimum. And I think more than that. Can they do that?
I don't think they're going to be able to pull that off. I think that there's too many signs of the economy weakening already. The leading economic indicators, which no one wants to talk about anymore, but they're negative year over year. They're negative 5% for the last 6 months annualized. That's a very strong sign of a recession in several months. The yield curve is inverted. Of course, that's 2s, 10s at negative 50. That's a precursor with a few-month lag of a recession. So I just think that with the CPI coming down and the unemployment rate will probably start to cross its 12-month moving average just by going up a little, because the 12-month moving average is falling. That's another high-frequency, important indicator of recession. With all those things going, I just kind of think that where the market's priced right now might be a little too aggressive. The market might be at 5 for the terminal rate. I'm going to go with more like 4.5.
So you go 50 in December?
Depends on the data, but yeah, I certainly, as a base case, I would say no 75.
And then after, you'll just have to see based on what the
well, how are you going to
is.
get? What's 450? I guess it's 75 basis points more or something. So a 50 and a 25.
So you tweeted maybe a week ago or so that you thought yields, particularly on the long end, have looked like they have peaked, or they will be peaking. Do you think they have?
It might have.
I guess, does today change the calculus of that projection from you?
No. The yield curve, flattened a lot. Long bond ended up giving up the ghost too, but it didn't drop very much. It's really the short end that really got hammered, as it should have been during the market today. So yeah, I mean, we peaked out on the 10-year at about 4.25. It didn't last very long, and I just think that if it gets back to 4.25, I think you're supposed to buy it.
So we've spoken many times, as we've told our viewers, and reminded them of these conversations that we've had every Fed decision day. And you said yourself how critical that you have been of the Fed. We're on 7 months into this new regime of raising rates. You've likened Chair Powell to Mr. Magoo,
yeah,
right? Going to drive this car into a dumpster. How would you now assess what the Fed has done, taking everything into consideration to this point?
I think they've played catch up in a pretty, I think, an admirable way that they've played catch up. I mean, they were slow, and it was compounded by the problem that the CPI was being driven by all these commodity spikes that have since relaxed. But they're kind of in the spot where I think that they should be at this point. I really think he's getting better. He does seem to have a tendency to get more hawkish the more he talks at these press conferences, and that really took the market into the woodshed today. We actually had an outside day down on the NASDAQ. The high today was higher than yesterday's high. The low was lower than yesterday's low, and we closed below any print yesterday. That's a very bad technical reversal signal.
The question is, will the real Jay Powell please stand up? Who is the real Jay Powell? Is it the one who, from here forward, I'm talking, sounded dovish in the statement, or was decidedly hawkish in his own rhetoric?
I think when people saw that in the statement, people often hear what they want to hear. I've learned that people hear what they want to hear and hear what they fear. And so when they heard that, it sounded dovish. But he definitely, I would not call that a dovish Fed press conference and meeting in its totality. I'd actually say, when the Fed chairman says, we think we're going to have to take it higher than we thought last time I talked to you, that sounds hawkish to me.
It certainly did to the market. Still have a ways to go, he said. The ultimate level of interest rates will be higher than previously expected. That was literally the moment where the market rolled over. You showed me the 2-year, which ripped higher, and that's kind of where we stayed for the rest of the day.
Well, we kept selling off. Stocks closed at the low. The 2-year Treasury closed at the high yield. And so, yeah, the market definitely took that as a pretty easy to comprehend statement. When someone talks about we're going to have to consider lags of monetary policy, okay, I'm glad that you're aware that there's lags, but you know that they're variable, right? That's the other part of the monetary lag quote from Friedman, I think it is. And it's sort of like, well, so how do you know what the lags are going to be? And frankly, he answered a question and he said, well, we used to think they were long and now research thinks they might be a little shorter. So the fact that he respects the lags might be fine, but I'd like to know how that is going to enter the conversation. So we're no longer just data dependent. We're now data dependent with a framework thinking about what we've done so far and what the lags might be. I'd like to hear more on that.
Okay. I'd like to hear more from you on the investment opportunities that lie ahead, given what happened today and what you just articulated, your feelings about it. Let's slip in a break.
All right.
We'll come back here in Denver to Schwab Impact, more with Doubleline's Jeffrey Gundlach. We'll find out where your money will work best in the months ahead next.
Yes, I think a recession is easily 60% in the next, I'd say, 6 to 8 months. And for the year 2023, I'd put it more like at 80.
At 80, okay. In terms of investing opportunities that I wanted to get from you, you tweeted at the end of September that you'd been buying treasuries. You told us that as well. You called it an unprecedented opportunity. Does that opportunity still exist to that degree?
It has to do with, yes is the short answer. It has to do with how it fits into a portfolio. Because I'm not saying you're going to make a fortune on long bonds, but what's happened in the bond market and the treasury market is part of this, so is the stock market, intertwined. We entered this year with no yield anywhere, and stocks wildly overvalued versus their own metrics historically of PEs, and price to book and all that. And as overvalued as stocks were by historical comparisons to stock valuations, they were actually cheap to bonds. Bonds were just terrible, but not anymore. Everything has changed. Stocks are, of course, way less overvalued than they were at the beginning of the year, but bonds have done really badly. And they've gotten so cheap to stocks that whole relationship is reversed. So not only are treasuries now potentially a profit maker, I mean, if the long bond is 4.25, it can go down. I mean, our model, which is the price of copper to the price of gold, which has worked very well over time, suggests that since copper's been so weak and gold has been stable, it actually suggests that the 10-year Treasury is overvalued by about 200 basis points in yield. In other words, it could fall a couple of % in yield if there's a recession next year, which is kind of what the model seems to be predicting. So that's a pretty interesting way of maybe making some money, but it allows you also, by owning those securities, it allows you to buy this bombed out credit market. Treasury yields have risen hundreds of basis points this year, but spreads on non-treasuries have widened. Spreads on guaranteed mortgages have widened by 100 basis points, so their yields are up, 450 basis points. Junk bond yields got out to 600 basis points. They've come into about 480. When you tack that on to a 4+% 10-year, you're starting to push 9.5%. You've got emerging market debt that's up at those yields. There's things in the single B, triple B category in fixed income that are asset-backed securities or different parts of the credit market where there are yields of 12%. Now, to take those yields, you've got to take risk and you've got to be aware that you could have some bumps along the road. That's what the treasuries do for you, because the treasuries will yield over 4, and if you can get a 12% return prospect from this credit stuff, you glue it together, you've got an 8% that has a natural hedge. Because if the credit does badly, the treasuries will do well, and if the treasuries just hang out, credit will probably have a pretty good year next year. And so that's a really good opportunity. It's far, far more attractive than stocks. Complete reversal of early January.
We've had many people sit next to me in overtime in this program and suggest that munis are the place to be right now.
They were.
Not anymore.
They're rich to treasuries in my view right now. They were cheap, and there was a big treasury rally, irregular, but a big treasury rally that munis didn't really participate in. So, sorry, I said rallies, a sell-off. So the yields went up on treasuries, they didn't go up on munis. And so treasuries became more attractive, and muni yields were more static. So as a trade, I think the yield comparison favors treasuries right now, although taxes are going up. They just raised my taxes in California by 1.1%, I found out. And there's a proposition on the ballot next week to raise them another 1.75. So that obviously makes munis a little bit more attractive. But they were cheap a few weeks ago, for sure, versus treasuries.
But maybe that opportunity
I think that's kind of been, the juice might be out of the orange on that one for the short term.
Interesting.
Also, I think there might be some tax loss selling that goes on. This will be a big tax loss year-end because there's losses everywhere. Everybody knows that 60-40 has been terrible. It's actually not the worst 60-40 of our lifetime anymore. It's now, 2008 is now worse again. It's back in the driver's seat. So there's a lot of losses. Bond index funds down 16%. You know, stock index funds, some are down, well, the Dow down 9, the NASDAQ down probably 24. A lot of tax loss selling. That could affect parts of the muni market. Might make an opportunity.
You said, we were on stage, for those who don't know, we were on stage and then we came right here.
Yeah.
You said that you thought that tax loss selling was one of the key risks right now in the market between now and the end of the year.
I do, because there's so many losses to be harvested. In every category, the only thing that is up year to date is the dollar and commodities. That's it. And the only thing that's up since the Fed started going to 75s, the only thing that's up is in traditional asset classes is the dollar. Everything is down. So there'll be pretty high tax loss selling, I would think. I even got a white paper from somebody saying, they're proclaiming to their clients this was the greatest tax loss selling opportunity of generation. I would say it might be 2 generations.
Wow. Speaking of the dollar, you have been looking for the dollar to weaken eventually.
Yes.
Because you think that yields have peaked? Do you think the dollar's peaked also?
I think we're getting close to a recession, and the response to the recession will be a collapse of interest rates. And since the dollar has been strong, thanks to the aggressive Fed, who has pretty much told us they're going to stay incrementally aggressive versus other countries, they're going to raise rates higher than they thought. They're going to keep them there for a long time. So I don't think the moment for the dollar weakness is here yet, but it'll come in the next recession. So maybe the time to position for a weaker dollar will be later in the first quarter, earlier in the second quarter of next year.
So that would mean, for those who have followed our conversations, you've suggested one of the best trades that you're waiting for is a weaker dollar and then a move by you into emerging market equities.
That's right. And I once had a profile written of me that called me Mr. Patient. And that's what I've been on this emerging market equity trade. I've been thinking about it for a couple of years, have not pulled the trigger, not even for a penny, because we need that dollar to weaken. But once that happens, I think you're going to have a double whammy of outperformance of the equities and a currency appreciation potential, which could lead to some pretty eye-popping returns, which should only be expected because market pendulums they don't swing and stop, just like inflation doesn't swing and stop. They swing and go past. So we could see some pretty eye-popping numbers out of this horrific couple of years in emerging market equity securities.
We'll leave it there. I really appreciate your time, as always, on this Fed Day, and I look forward to doing it at the next meeting.
Yes, sir.
It's always good to get your first look at what happened and what was said. That's Jeffrey Gundlach of Doubleline joining us here in Overtime exclusively. Mike, I'll send it back to you.